The role of patience in successful trading is almost always underestimated, largely because patience produces no immediate evidence of value. It does not create excitement, it does not generate stories to tell, and it rarely feels productive in the moment. Yet trading literature, written by those who have lasted long enough to see multiple market cycles, converge on the same quiet conclusion. Patience is not a passive trait in trading. It is an active discipline, and without it, every other skill eventually collapses under pressure. In trading, impatience often disguises itself as ambition. The desire to act, to participate, to capitalize on movement feels responsible, even professional. New traders especially believe that being active is proof of engagement, while waiting feels like hesitation or fear. This misunderstanding is costly. Markets spend far more time doing nothing than offering clear opportunity. Patience is what allows a trader to distinguish between movement and meaning. Without patience, every fluctuation feels actionable, and noise slowly drains both capital and confidence. One of the first places patience shows its value is in trade selection. Successful traders do not look for reasons to trade. They look for reasons not to trade. This inversion of mindset changes everything. Instead of asking, "Can I make money here?" patient traders ask, "Does this truly meet my criteria?" Trading literature repeatedly emphasizes that most profits come from a small fraction of trades, while most losses come from marginal ones taken out of boredom, anxiety, or the fear of missing out. Patience acts as a filter, quietly eliminating low-quality decisions before they ever become problems. Patience is also essential in letting trades develop. Many technically sound trades fail, not because the idea was wrong, but because the trader exited too early. Fear of giving back unrealized profit, discomfort with open risk, and the need for closure all push traders to interfere prematurely. Successful traders understand that probability unfolds over time, not instantly. Patience allows the trade to express its edge. It accepts that discomfort is part of participation, and that micromanagement often does more harm than protection. Another critical role of patience appears during drawdowns. Losing streaks test belief more than strategy. Impatient traders respond to drawdowns by changing rules, increasing size, to recover faster, or abandoning systems prematurely. Patient traders respond differently. They reduce size review behavior and allow time for variance to normalize. Trading literature consistently shows that many strategies fail, not because they lack edge, but because traders lack the patience to let that edge play out over a statistically meaningful sample. Patience also protects traders from emotional extremes. After winning streaks, impatience appears as overconfidence, the urge to trade more aggressively, while momentum feels favorable. After losses, impatience appears as urgency, the need to get it back. In both cases, patience serves as a stabilizer. It slows decision-making, restores perspective, and keeps risk aligned with reality rather than emotion. This stabilizing effect is one of the most powerful yet invisible contributions patience makes to long-term consistency. There is also a deeper psychological dimension to patience that trading literature often hints at, but rarely spells out clearly. Patience requires acceptance of uncertainty. It means accepting that you do not control when opportunities appear, how long they take to develop, or when results will materialize. This acceptance runs counter to the human desire for immediacy and certainty. Traders who cultivate patience are not indifferent, they are realistic. They understand that forcing outcomes in a probabilistic environment is a form of self-sabotage. Over time, patience reshapes a trader's identity. The trader stops seeing themselves as someone who must constantly act and starts seeing themselves as someone who waits for alignment. Waiting becomes purposeful rather than empty. inactivity becomes a position rather than a failure. This shift reduces stress, sharpens focus, and allows energy to be deployed only when conditions justify it. Many seasoned traders report that their most profitable years coincided with trading. Less, not more, a paradox that only patience can resolve. Perhaps the most overlooked role of patience is in learning itself. Skill in trading does not compound linearly. There are long periods where improvement is invisible, followed by sudden clarity. Impatient traders interpret these quiet periods as stagnation and change direction. Patient traders stay the course long enough for patterns to reveal themselves. Trading literature often frames this as earning the right to see a process that cannot be rushed without being compromised. Ultimately, patience in trading is not about waiting for the perfect moment. It is about waiting without deteriorating emotionally, financially, or psychologically. It is about preserving clarity when nothing is happening and restraint when everything is happening. And it is precisely at this point, when patience is no longer something you try to practice, but something that naturally governs your decisions, that trading begins to feel less like a struggle against the market and more like a disciplined observation of opportunity unfolding on its own timeline, a process that continues quietly forward as long as you are willing to respect time as an essential component of edge rather than an obstacle to overcome. And this is where the deeper understanding of patience has not yet fully reached its end. Because the deeper you go into trading, the more you realize that patience is not something you switch on. When you remember to, it is something you build into your environment, your rules, and your identity. Traders who rely on willpower to be patient eventually exhaust it. Traders who design patience into their process make it inevitable. This distinction separates those who occasionally trade well from those who remain consistent over long periods. At an advanced level, patience becomes visible in what a trader refuses to engage with. They do not chase late entries. They do not trade during conditions their plan explicitly excludes. They do not expand risk simply because the market is active. These refusals are quiet decisions rarely noticed by anyone else, yet they account for a large portion of long-term profitability. Trading literature often notes that what you avoid in trading matters as much as what you pursue, and patience is the mechanism that makes avoidance possible. Patience also matures into timing intelligence. Rather than reacting to the first sign of a setup, experienced traders allow price to confirm intent. They wait for structure to form, for momentum to align, for risk to be clearly defined. This waiting is not indecision. It is information gathering. Each moment of delay reduces uncertainty slightly. Over hundreds of repetitions, this disciplined timing significantly improves average trade quality without increasing trade frequency. There is a particularly important role patience plays in protecting self-trust. Every time a trader forces a trade and regrets, trust erodes. Over time, this erosion creates hesitation even on valid setups. Patient traders experience the opposite cycle. By waiting consistently, they reinforce trust in their own judgment. When they finally act, they do so without inner conflict. This clarity improves execution, which in turn reinforces patience further. The loop becomes self-sustaining. Patience also extends beyond individual trades into how traders evaluate progress. Those who demand quick validation constantly adjust strategies, change markets, or abandon plans prematurely. Those who practice patience allow time for feedback loops to complete. They measure progress over meaningful samples rather than days. Trading literature repeatedly highlights that most edges reveal themselves only after enough repetition to smooth out randomness. Without patience, traders misinterpret noise as signal and sabotage their own learning. Another subtle but powerful expression of patience is knowing when to step away entirely. Markets are not always conducive to clear decision-making, and neither are traders. Fatigue, emotional stress, and external pressure degrade patience quickly. Experienced traders recognize this and disengage without guilt. This withdrawal is not avoidance, it is strategic preservation. Patience here means waiting for yourself to be ready, not just the market. Over time, patience changes how traders experience uncertainty. What once felt intolerable becomes manageable. Waiting no longer feels like wasted time, but like preparation. The absence of action becomes comfortable. This comfort does not lead to complacency, but to heightened selectivity. Opportunities stand out more clearly against the background of inactivity. Trading becomes less noisy and more intentional. Ultimately, patience is the skill that allows all other skills to function. Without it, risk management is ignored, strategies are abandoned, and psychology unravels. With it, trading becomes coherent. Decisions align with rules. Emotion stays contained. Time works in your favor rather than against you. And so the role of patience in successful trading cannot be overstated. It is not a virtue layered on top of technical skill. It is the foundation beneath it. When patience is integrated into how you plan, execute, and review trading, stops feeling like a constant test of restraint and starts feeling like a steady practice governed by clarity rather than compulsion. It is here, in this quiet mastery of waiting, that traders find the space for probability to express itself fully without being interrupted by the urge to act too soon or too often. And this understanding continues to deepen as long as markets exist and human nature remains unchanged.